Hello and welcome to this video. In this video, we will be discussing the current developments in geopolitics and how they are affecting the oil prices and financial markets. Geopolitics has suddenly become a factor again, as the OPEC has decided to cut oil production by a significant amount, which has caused oil prices to shoot up. This, in turn, has led to inflationary tendencies, and the Fed may have to raise interest rates instead of lowering them. This is what the bond markets are currently indicating, as bond yields are rising and putting some pressure on stocks. Let's take a closer look at what has been decided. Russia and Saudi Arabia have each cut 500,000 barrels per day of oil production, and together with other countries, a total of 1.15 million barrels per day have been saved. Additional production cuts have also been promised. The OPEC meeting was originally scheduled for later, and it was expected that nothing would change. Therefore, this move comes as a surprise, and insiders say that the Americans have told the Saudis that they would replenish their strategic oil reserves. However, this did not happen. The Biden administration massively reduced the reserve amount, and there was no commitment to refill it. The Saudis relied on this commitment and are now upset that it was not fulfilled. This is driving oil prices up and benefiting oil producers overall. The political implications of this decision are significant. The EU has said that they will not buy Russian oil if the price is above $60. However, if the oil price continues to rise, Europeans may no longer buy it. The Japanese are also not allowed to buy it, but they have a problem and urgently need Russian oil. Therefore, they have consulted with the Americans and said, okay, we can make an exception. However, if Japan is allowed to buy oil from Russia for over $60, other countries will say, we need it too. It will be interesting to see how the geopolitical situation develops. A rising oil price usually also leads to increasing inflation. Overall, the service sector and core inflation are the biggest problems. Energy is not the problem anymore, but if energy becomes the new problem again and global prices continue to rise, the ECB must continue to act. Accordingly, bond yields are rising, which contradicts the rally in the tech stock markets. March was a particularly successful month for tech stocks. They performed well because it was assumed that in the event of a banking crisis, the Fed would be forced to lower interest rates, which is good for tech, and liquidity is also good for tech. That's it for this video. Thank you for watching, and don't forget to subscribe.